Hey, this is Spencer Correnti. I run Alkaline Advisors, and today we will be reviewing our premium hospitality acquisitions model. So to start, I'll give you all a high-level overview on what the model entails and how it operates, and then we'll dive into the nitty-gritty. My thought is it'll take about 20 minutes, but we will separate everything out by section on the video, so feel free to skip around. Okay, so to start, this is what we call a fully dynamic financial model. Essentially, you'll see we have blue tabs down below, and then within the blue tabs, you'll see we have blue cells. Once you populate your information into the blue cell, everything else in the model will update automatically. And you'll see we really only have 3 blue tabs, which you need to put your information into, and then everything else will auto-populate. So we'll start with the Inputs tab. The Inputs tab is where 95% of all inputs and assumptions are housed, and we've broken it out by section. You'll see we'll have our project return section up top. This is where you could see the profit, IRR, and equity multiple of the project without debt and with debt on the left. And then on the right, we have the partnership. So we have the return metrics for the GP and then the LP. Underneath that, we have general project inputs. Then we have a majority of the operating inputs, and I'll get to where the rest of them are housed in a moment. But here we have the room mix, we have the ADR growth, operating reserves. Underneath, we have the financing inputs, so acquisition loan, perm loan, pref equity. You can toggle this on or off. We have the sensitivity analysis, and then we have the SOFR curve. On the hospitality operations tab, this is where the remaining inputs for the operations are housed. This is where we calculate more or less the fixed variable inputs at the operating statement level. So here is where we do it for revenues. Underneath is expense. Then we have some additional revenue inflation estimates, and then expense inflation estimates. And then we have the occupancy schedule on a monthly breakdown. We'll get into all this in more detail later. Then we have partnership return section. Here's where we can separate out GP and LP information. The next green cells are where the calculations are housed. So we have the fixed variable calculations, the rent roll, cash flow. This cash flow tab is where the full DCF is housed, broken out by acquisition, operating statement. Then we have partnership equity. Then we have pref equity if there is any, acquisition loan, perm loan, operational reserve, sale value, and all of that breaks down into the unlevered cash flow and levered cash flow line items. Then this tab is annualized on the annual cash flow tab. Then we have the loan amortization section. And then finally, we have investor summaries. This is a 3-page breakdown. And we have a lender summary. So with that, what I will do is I will jump back into the inputs tab and we'll go through how the model works in a lot of detail, really walk through step by step how you can use it. And this model can be used for back of the envelope analysis, or it could even be used for really nuanced in the weeds analysis to see if a project will work given the assumptions that you have. So zooming out to start, when we are thinking through models, we obviously focus on the details as it relates to the actual technical side of the model and how the numbers flow through, but we also really focus on the layout and the format. So we say that our models are part art and part science. And at its core, we really focus on 3 types of variables and inputs when it comes to the model. First, we have the contributions. Next, we have the distributions. And then finally, we have the timing. Contributions is how much are we spending. Distributions are how much are we receiving, and the timing is when does all of that happen. And with those 3 core variables, we're able to understand whether or not a project makes sense at a financial level. So we'll start on the inputs tab with general project inputs. First, we have the general information over here. You can just type in where the project is, what type of project it is, and the size. All of this flows through to the rest of the model. So for instance, if we say the sponsor's name is test 1, 2, 3, and we go back to the cover page, you'll see test 1, 2, 3 populates on the cover page. It populates in the investor summary and everywhere else applicable. Next, we'll go to project timing. In this section, we're able to say when the project starts and then when are we selling the asset. So let's say we sell in month 60 instead of month 120. You'll see all of the figures will update automatically as it relates to the return profile. Next, we'll have the acquisition valuation section. Here, we're able to determine at what purchase price are we buying the asset for. And this is for a hotel, hospitality. So we can choose how we're purchasing the asset. Are we going to use a purchase price? If we select purchase price, we can dial in a figure. We can choose if we want to purchase at a purchase price per square foot figure, and then it'll go down to dollar per square foot. And then finally, we can choose if we want to purchase it at a cap rate. So we could use a direct cap approach and then say, okay, are we purchasing the asset using in-place NOI, year one NOI, year two NOI, or stabilized NOI? So we can say in-place NOI for now. Then we're able to dial in our closing costs and acquisition fee, and that'll give us the total investment amount because it's factoring in the room renovation CapEx, which we'll get into. It's calculated down in the operating input section, and it's also calculating the project CapEx. So right now we have no dollars in project CapEx. Project CapEx section is right here. We can say we want to load in a test 1, 2, 3 line item. We are going to say we'll spend $250,000 on it, and we'll start incurring the costs in month 3 and end those costs in month 8. So then this $250,000 is straight lined, evenly distributed starting in month 3, ending in month 8. And you'll see that is now part of the acquisition cost, the total investment amount. Next, we have the stabilized valuation section. So here we're determining at stabilization what cap rate are we using to value the asset and what NOI are we pulling. So we can choose the in-place NOI, which we probably won't want to do as much if there's a lot of seasonality for the hotel, because it's just going to take 1 month, whatever month you're stabilized, and then or whatever month stabilization begins at, and it's going to annualize that. So you probably want to take the forward 12 NOI. Similarly, with sale valuation, you can choose, are we taking the forward 12, the trailing 12, or the trailing 3 and annualizing it out. So we'll choose forward 12 again, and we can choose the cap rate and then selling costs. Next, we have the operating input section. Here, we're able to outline the types of rooms or units that we have at the hotel. So here, we're gonna, in this scenario, just say we have 100 units. They're all the same. When we purchase them, they're all going to be priced at $200 per night, right? That's their average daily rate. And what we're gonna say is, post-renovation, they're going to be $250 per night. So we're going to say we want to renovate all 100 rooms. It's going to cost $30,000 to renovate each room. We're going to start the renovation in month 1, and we're going to renovate 5 units per night, 5 units per month, which means that the renovation period is going to end in month 20. So in month 21, that's when we're going to say we are stabilized. So if you see, we can say we're actually going to renovate these rooms at 10 a month. Now we're stabilized in month 11. So you come up here, you'll see stabilization updates to month 11. So again, everything auto-populates based on the inputs we have here. Next, we'll go to ADR growth. This is a pretty neat feature that we built out in terms of the occupancy methodology. So right now, in terms of ADR, the average daily rate growth at a room level, we can then escalate it on an annual basis, so X% per year. What we've done for occupancy is we can say, how are we going to escalate occupancy? What is occupancy based off of? We can say that occupancy is just going to be if we select static, it's going to be a flat X% every period, every month, every year. So here we're saying it'll just be 80% throughout the duration of the hold period. Next, if we toggle instead of static, annual, we can then choose in what year are we going to have what occupancy rate. So this enables us to have, 6 different rates, 1 per year up to year 6. Then that year 6 plus will be will be static at whatever you have input here. And then finally, we're able to say instead of annual or static occupancy, we want monthly. So if monthly is selected, this all grays out. We'll go to the hospitality operations tab, scroll down to the monthly occupancy schedule, and then we're able to fill in the months in each given year in terms of when we're holding the asset. So here we start in August of 25, because that's the purchase date, and then we're selling the asset 10 years later, 2035 in July. So we can fill all of these in. And just so you can see, if we toggle instead of monthly, annual, or static and hop back to the operations, this is all grayed out. This information doesn't flow through to the model because you don't want it to flow through to the model. So we'll go back to the inputs tab. Next, we have the operating reserve section. Here you can choose when and how we're holding back capital at an operational level to cover potential future shortfalls in operations. So if we say no, that means we don't want to hold any capital back. We don't want to hold any free cash flow back. If we say yes, we can choose what percent of free cash flow are we sweeping to cover future shortfalls. So in this scenario, we don't have any future shortfalls, so we aren't going to hold any capital back. But if we did have shortfalls, we would hold the capital back, and then we'd reserve as much money as we needed to cover those shortfalls. So we can toggle this back to no. See, and you'll see analysis does not reserve cash flows above future required shortfall. So for instance, if maybe this was 100 a night, let's see if the shortfalls would kick on. Yes, there would be shortfalls. So we have shortfalls of $9,400. However, you'll see we're not reserving any capital because these shortfalls happen before we have additional free cash flow that we're able to then sweep to fund the shortfall. So that would be if this was then, the post renovated was, let's say 150, then we have some free cash flow that we're able to hold back. Okay. Next, we'll go to the financing input section. The financing input section is segmented into 3 categories. The first is acquisition loan. The second is pref equity. Both of these 2 categories are going to help on the acquisition of the asset. And then the third section is perm loan. The perm loan is going to be the loan that comes into play when you want to refi out of the acquisition loan, and if you have additional and available capital out of the pref equity / mezz debt piece as well. So we'll start with the acquisition loan. First of all, if you don't anticipate having any capital, any debt when it comes time to acquire the asset, you can toggle this to no. Then you're using only equity. If you toggle this to yes, you'll see all of the variables allow you to input the data. So you can choose what LTV you want, and you can also choose what in the acquisition is being financed. We have purchase price, closing costs, AC fee, project capex, and room renovation capex. Again, the project capex is tied to this segment, so just general capital expenditures at a project level, and then the room capex is tied to the cost to turn each room to bring it from the current ADR or ADR at acquisition to the post-renovated ADR, which is the average daily rate. Then we have the loan fee, we have amortization period, interest only. You can choose if the loan is fixed or floating. If it's fixed, it's just a straight fixed percentage. If it's floating, you can choose how many points over SOFR it is. We have a floor and a ceiling. And then SOFR is down here. You can paste it in directly from Chatham Financial, which we've included the link to over here. And then here we give you the functionality to put in the forecasted figures or the actuals based off of what they already were if you're backloading some information. That being said, if the actual period has already happened and you haven't updated the figures, so for instance, this remains 0, it'll tell you to update the SOFR curve, but at the same time, we are using the information that was initially dropped into the future 1 month SOFR curve. So in this scenario is 4.29%, so that it's not drawing from the 0%. So you're going to be off by whatever the margin was or the spread was between the anticipated SOFR curve when you first loaded it in and what it was inevitably at the time that you load in the historicals. So next, we'll jump down to the pref equity piece. If you have pref or mezz, honestly, this could be used for both, but you would toggle it on. You could choose what the capital amount would be. You could choose the fees, whether there's upfront fees, exit fees, and with the upfront fees, you can choose if you have to pay those fees current or if those fees are accruing. You can choose what percent interest is current pay versus what the accrued interest rate is, and if that interest that is accruing is compounding or if it's non-compounding. You can then choose the percent that we are sweeping of free cash flow to pay down the pref equity. And then finally, we can choose if there's a minimum equity multiple that the pref and or mezz needs before you pay it off. So right now we don't have anything. It's at a 1. And you can see we're paying off the pref in month 13. Let's say we have, and you'll see that the pref is at a 1.04. So let's say we want 1.1 minimum equity multiple. There's an additional payoff in month 13 of 56,244,000 so that we hit that minimum equity multiple. And let's say if it's a 1.5, you'll see now the payoff amount is in month 15 because we don't have enough capital until month 15 to pay off the additional piece for that minimum, to hit that minimum equity multiple. The next feature we'll talk about right now is the perm loan functionality. So in this box, you can see you can toggle it on or off. If you have it off, what we're going to do is use proceeds from sale to pay off the acquisition loan. If it's toggled on, then you will refi out of the acquisition loan with perm financing. And to the extent you can pay off the pref equity or mezz piece, you'll do that as well. So when we're sizing this perm loan, we're using 3 parameters. The first is LTV, the second is min DSCR, and the third is minimum debt yield. So you'll see in this scenario right now, we're saying that we want a 60% loan to value, and we're able to achieve that based off of the other parameters, be it DSCR and debt yield. However, if we say the lender wants, for instance, a 1.25 min DSCR, you'll notice that this actual LTV lights up yellow and it decreases from 60% as it was before to 57.1 because we had to decrease the LTV in order for our min DSCR requirement to be hit at that 1.25. And you'll notice also the loan amount will size itself accordingly. So now it's 25.7 million, before it was 27 million. Same thing with the debt yield, the min debt yield. If we up this to 10%, you'll notice this arrow drops down here. We're no longer able to secure a 60% LTV, it's 55%, and that loan amount dropped down further to $24 million. So we can choose when we're refinancing the asset, and we can choose it right here. Right now we're saying month 24. You'll see we're stabilizing month 21. You can choose how we are capturing the NOI at refi. Are we taking the forward 12, the trailing 3, or the in-place NOI, and at what cap rate? You'll also notice if we say we want to refi in month 20, this will light up red. Why will it light up red? Because it's saying, and you'll see this also lights up red, but for a different reason. This is saying that, hey, you are refinancing before you're stabilized. Are you sure? And that might be the case, but it's just giving you a warning. At the same time, this up here is saying, hey, you cannot pay off your acquisition loan, so you need to come out of pocket $8.1 million in this scenario. So for instance, if we 20% LTV up front, given everything that we input over here, now we are able to pay off that initial loan amount of here. You'll see it's $5.8 million. So you don't have to come out of pocket anything because the value or the loan amount here, 10 million, is sufficient of paying back the 5.8 million. But again, if we have a $19 million, a $19 million loan amount that we needed to pay off, and we only have $10 million in proceeds here, obviously you can't cover everything, so you need to come out of pocket. And this will show you how much you need to come out of pocket for. So underneath, similarly, we have the amortization period, the interest only period. Is the loan fixed or floating? What's the caps for floor and ceiling, and how many points over SOFR? The next and final piece in the inputs tab is the sensitivity analysis section. Here, what we're doing is we're taking a 2-variable sensitivity. The first piece we're sensitizing is sale month, and the next piece is exit cap. So right now, also this is a cool functionality as well. You'll see, note, if return cell is red, update data table, you have to go to formula and calculate now. What this is saying is that you just need to refresh based on that calculations have changed. This table, you need to click a refresh button essentially in order for it to calculate automatically. So you click calculate now, it's refreshed, everything checks out, the red and yellow disappear. So essentially what we're saying is if we sell the asset in month 120 at a 5.5 cap, we're going to profit close to $30 million. And what we're saying, if you scroll all the way up, is we're selling at month 120, we're selling at a 5.5 cap, and you'll see here our profit is roughly $30 million. However, we're also saying, well, what if we sold in month 96 at a 4.5 cap, or month 144 at a 6.5 cap? This is showing us the full range of where our profit would lie if the time of sale and the exit cap varied. Now, in that same vein, this is only showing the profit at a levered project level, so inclusive of debt. What we can also have it show is the IRR and the equity multiple at not just the project level, but both a GP and an LP level. So for instance, we can click GP IRR. You'll see red, yellow, click calculate now. This is what the GP's IRR would look like if, again, you sold within this range. So this is the inputs tab. The next tab we'll go to is the hospitality operations tab. This is where a majority of the other inputs are going to be. And these inputs are going to cover the other revenues and expenses during the operational period. So you'll see up top, we have stabilized operating statement. This will just show us the room revenue versus the other income, and then also breaks out the expense segments, and then shows us the NOI. And this is at stabilization. So the way that we've broken out this hospitality operations tab is by saying, okay, how do we want to calculate the initial costs or other income at stabilization? And then and that's what we do right here, stabilize other input revenue. So when we, for instance, say, okay, food, we want the food revenue line item to be either X dollars per occupied room. We can select total and just say Y dollars per year total. Or we can say it'll be a percent of room revenue. And for the percent of room revenue, it'll be X% of the revenue at a room level for stabilization. So we can just say $100,000. And you'll notice all of these are the same with the addition of, then you can have a percent of food revenue when it comes to beverage, event F&B, or any other input down here that you can load in. Same thing with expenses. You can toggle between and we have more functionality for expenses. We have per occupied room, we have total, and then you can do a percent of room revenue, percent of food revenue, percent of F&B, percent of event F&B, percent of other revenue, or a percentage of total revenue. And depending on what you toggle, you'll see, for instance, if we do per occupied room, it is conditionally formatted. So it'll say 10,000 per room if we want a total, and that'll flow through the model accordingly. If we want a total, it'll be 10,000 per year. And then if we wanted a percentage of anything, the percent figure would pop here. And you'll also notice if we have total, this fixed variable input section is grayed out. And if we have a percentage, it's not grayed out. So the way that the fixed variable input section works is essentially it's saying that at the point of stabilization, X% of the other revenue or the operating expenses are going to remain fixed. So in this scenario, if we say F&B expenses, we're going to say 50% remain fixed, and then the other 50% are going to fluctuate. They're going to be variable depending on this 30% of F&B revenue in a given period, in a monthly period. So that's how we'll calculate the fixed variable input section. And then given all these inputs and assumptions, they all flow through to calculate the actual cash flow on the CF tab. And we'll get to that in a second. But other inputs on this tab, you'll see we have post-operating expenses. So you have an asset management fee. You can toggle that to go to either a percent of room revenue, a percent of total revenue, or you could just hard code that figure. Underneath that, we have the revenue inflation estimate. So you'll see we have food, beverage, event F&B, other revenue. We can trend these figures or grow these figures just saying X% per year if we keep it fixed. Or if you want to have a little more functionality, you can say custom, and then we'll grow them at Y% every year, starting in year 2, ending in year 6 plus. Similarly with the expenses, it functions the same way. And then we have the monthly occupancy schedule down below. Again, this is on the inputs tab. What you'll do is you'll toggle monthly if you want it. If you don't, you can click annually or static. Hospitality operations, now it's not here. So that is the hospitality operations section. Next, we'll go to the partnership returns section. In the partnership returns section, it's very straightforward. Let me zoom out a little so you can see it. It's a 3-tiered equity waterfall structure. We're saying that the GP is bringing X% of the equity to the table. The LP makes up the remaining balance. we're saying that the GP LP hurdles could either be no hurdles in pari passu, or one hurdle with a pref rate and then a promote thereafter. It could be 2 hurdles, 3 hurdles, where we have whatever IRR the LP needs to achieve before the GP hits that next promote tier. Similarly, we have functionality for the compounding frequency. So how is the pref compounding? Is it compounding annually, monthly, or no compounding? Distribution frequency. How frequent are the distributions to the LP? Are they monthly? Are they quarterly? Are they annually? And then finally, we have equity contribution. So this is a pretty interesting piece because you'll see it's tied to the charts and graphs for the investor summary. There's not that much capital coming in after time 0, but you'll see if you can see, we'll zoom in. We've got some bumps over here, really not many at all. So actually, let's make this input just so you can see the difference. 2.5, let's make it 25 million. And then we'll go to the investor summary. Now you'll see we've got some capital costs coming in over here. If we go back to the partnership return section, you'll notice equity contributed is on incurred. So we're bringing equity to the table whenever we need it at any given period. If we toggle up front, we're front loading all of the equity, saying, hey, all equity is needed time 0. We can go back to the investor summary and you'll notice this chart updates. Why? Because it's the sources of funds. We just said we're collecting everything up front. And then with the uses of funds, it holds the same pattern. So let's go back to the partnership return section, go back to incurred. That's the partnership return section, and everything else in this model auto-populates. So here's the fixed variable calculation section on an annual basis, so you can see how everything is being calculated. Scroll down. Next, we have the rent roll section. So similarly, this is just illustrative. You can see all the information in more detail, occupancy percent, and then however many days are in the given month, the room rate, renovation schedule, CapEx schedule, room nights sold, room nights available. And by the way, right now, these are only one line item is populated. But if you go to the inputs tab, you can load in rooms individually. You can load in different types of rooms or different lines of rooms or different levels of renovation per room. And then everything will populate accordingly. Go back to rent roll. We have room nights sold, room nights available, and then non-renovated market ADR, renovated market ADR. Because theoretically, you might not want to renovate all of the units at a given point. Cash flow, this is the DCF. This is where all of the cash flows are housed. You'll see we've got the acquisition section up top. Underneath that, we have the operating statement. And if we click to expand, you can see the total keys available versus and then we've actually outlined the occupancy and the days open, the room nights available, the rooms occupied, the percent of years occupied, and then the RevPAR down below. So then we have the operating income. Underneath, we have the total room revenue. Underneath that, we have other income. Underneath that, we have total income, then the operating expenses, total departmental expenses. We have undistributed expenses, total undistributed expenses, and all the way at the bottom, we have NOI, and then we have the value down here. And the value is just a snapshot saying, okay, if we want to cap it at stabilization or sale, what does that look like? How and why? Next, we have the partnership equity. This is just the equity as it's being drawn in. Then we have the pref equity. And in this case, we are also drawing down pref times 0. Let me move this back to 250. You'll see all the pref comes in times 0. And then for the loan, it also comes in times 0. And then we are making payments throughout the duration of the loan until refi in month 24. And you'll notice in month 24, we pay off the loan. We then have perm financing online. We have interest until we ultimately sell the asset, in this scenario, month 120. And then we're using proceeds from the sale of the asset down below to pay off the payoff value. We have operational reserves here. We're not actually reserving too much, but we're actually not reserving anything in this scenario because we've toggled the reserves to no. And even if we toggled it to yes, I don't think we'd be able to reserve that 51,000 just because it's happening early right here. So before month 7, and we don't have the free cash flow to even make the distributions to capture that. But all of this is factored into the amount of equity that you'll need to bring to the table upfront or in the period that it happens so that you don't run a shortfall. And then finally, all of those figures flow to this levered and unlevered line item. Unlevered is without debt, levered is with debt. The other segment right here is contributions and distributions. This is almost a separate segment in and of itself. It's a gut check. You could see that the total profit here equals the total profit here. What this is saying is, as I said before, we like to think about contributions, distributions, and timing as the main variables. We've broken the contributions out into initial contributions and then operating shortfall. That gives us the total equity required. Underneath that, we have distributions from operations and net distributions from both the refi and the disposition, the capital events. Those two together gives total distributions, and then distributions less the contributions would be the profit. Okay. Then we have the same snapshot, but annual cash flow. So this is annualized. We have the loan amortization schedule. So it's amortizing that acquisition loan, and all of this updates automatically, all the gray. And then we're amortizing the perm loan, and it'll tell you floating plus 700, floating plus 200. Next we have, and then finally we have the investor summary. This is a great snapshot. You'll see it's a 2-page printout, and it highlights the investment description. It gives you return profile and metrics at different points in time, at stabilization, at refi, at sale. We have deal notes. This auto-populates based on the formulas. We have metrics and returns at the project level, without debt, unlevered, with debt, levered, pref equity, LP, GP. And you'll see if we turn pref equity off, it just won't flow through, and it'll say no. And we'll go back to investor summary and no pref equity. And similarly over here, we don't have pref equity in the sources and uses. You'll notice the sources and the uses tie out. This will update automatically. The charts update automatically. The graphs update automatically. Sensitivities, operating statement. And you'll notice here, operating statement looks pretty consistent. If we go back to inputs, you'll notice that the occupancy methodology is 80% on an annual basis. If we toggle it to monthly and we go back to hospitality operations, scroll down, you'll see January we're at 25, February we're at 30% occupied, then 50, then 70, then 75. So it fluctuates pretty drastically. If we go back to the investor summary, boom, the chart updates automatically, and you'll see there's a dip here because that's, we have additional low periods of occupancy in this time period, in this time frame. Then we have stabilized month 21. We have sale month 120. We're using the forward 12 to capture NOI. We're using the forward 12 here. But if you toggled in place or trailing 12 or trailing 3, everything will update. And then we have the annual summary. So this is another snapshot, but it doesn't go into as much detail in depth as the full annual summary on the annual summary cash flow tab. And then you can see if we click open, we have partnership splits. So you can see what the GP-LP return structure is on an annual basis. But if you don't want to show that, you can hide it as well, and then it will be there when you present to someone. And then finally, we have a lender summary. This is a 1-page snapshot that just shows what the initial debt request is, the property snapshot at loan takeout, what the refi looks like, sources and uses at a project level, sources graph, uses graph, operating statement, and that is really it. It's pretty straightforward. It's very easy to use. We try to make all of our models pretty simple to use. This is our premium hospitality acquisition model. We have models for everything, and we also customize all of our work as well. So if you have a situation or you're working on a project that doesn't fit nicely into a box, we could build something out, whether it's a brand new model or just additional features to an existing model. More than happy to help in any capacity. But really appreciate you spending the time to watch this video. Please feel free to reach out with any questions. Again, my name is Spencer Correnti. I run Alkaline Advisors, and I look forward to hopefully hearing from you one day. Talk to you soon.